because here you go. All right. This is how you manage the risk. What a good question. And look at that. I know you didn't even see my presentation tonight. So I'm going to get to it. So spreads are important and powerful tools in trading. Okay. Spread is when you combine more than one position on the contracts based on the same underlying security, obviously, to create one overall trading position. All right. Here's an example. If you bought in the money calls on a specific stock and then wrote a cheaper out of the money call on the same stock, then you just created a bull call spread. You're essentially betting that the stock is going to go up. But by doing that, you can control some of the risk. And for those of you that were in Trade of the Week back in March, we were doing spreads on Trade of the Week because the volatility was so out of control. So for those of you that were here in March and the end of February, that's what we were doing. We were doing spreads on Trade of the Week, okay? Because that is the way to control the risk. Now, you're not going to make as much, okay? You're limited in terms of your profit, but you've also lowered your initial cost and you've lowered how much you can possibly lose should that trade go against you, okay? So that's one way to do it. Now, if you were to take, like I was just saying, so let's say you took a Microsoft at 200. You bought the $200 call and the stock starts to dip, all right? And you say, oh, you know what? I'm out of day trades. I've got the margin. I can do this. Let me sell the 195 or the 190, right? So now you've sold a lower call and essentially you have bought a higher call, but you didn't do it in one felt swoop. So you paid, let's say you paid, I don't know, the stock's at 200. Let's say you paid $5. You paid $5 for the 200 call. And now you've sold the 190 call for like, let's call it, I don't know, $8. You've actually received a credit between the two trades of $3. Okay. So when you add that to the strike, that would mean if you took it to expiration, you need it to be under 193. Because then your 200 would expire worthless and your 190 break even because it's the strike price, which is 190 plus the $3, right? Plus $3. Yep. Because it's $3 is 193. So if the stock were to close at 192.90, you get to keep the $300 and you've turned a bull call into a bear call spread. That's what it's called, the bear call spread. And I cover this if you guys take the spread course with me, but I'm still working on doing the spreads for you and I'm just about done with the webinar, so bear with me. That's the one I'm going to do for everybody, which will be way cheaper than a one-on-one. But then you have turned it into a bearish position. You got that, Tony? Does everyone understand how that works? Does everyone understand how that works? Did you guys follow along with me? Go ahead. You can ask another question. You're going to ask it? You're on like Southern time, right? So this is going to take like a week. Longer term, okay. Go ahead. Can you open a spread and manage? Of course you can. Of course you can. There's different ways to do that. I mean, but why would you do a $1 spread? I mean, I wouldn't do a $1 spread. It's not gonna. What are you gonna do with that? So let's say the spread makes you. I mean, you could. You're gonna do an iron butterfly. Yeah. You can. Are you talking about buying? Are you talking about buying the out month and selling the out month? Or are you talking about, like, let's say you were going to do September. Are you talking about buying and selling September? Both of them? Or are you talking about buying September 75 and then selling, let's call it July 76? Okay, so you're talking about the same month. Okay. Yeah, you can. Why couldn't you buy back the short? Of course you could. I do it all the time. I like to do calendars, especially around earnings time. Because if I really, like, everybody, look at the Boeing trade that we did in life. What did you guys make on that? You guys made a killing, right? You made a killing on the Boeing trade and you made a killing on the American Airlines trades. Remember those? We bought back the shorts in the front month and we crushed the longs. I want to say that was what, April? Crushed them. Right? I'm pretty sure those were the two names that we did that on. Yeah, you can always do that. I mean, I would always suggest doing a diagonal because then you can keep selling more. Like, didn't I just do a trade? Didn't I just do a trade this week on that? Let me look. Hold on a second. I think I just did a trade like that. What's the one I just did? TSM. So here was TSM. I bought the August 75, right? And I sold this week 75. The net debit was 135. Plan to adjust the short next week. That's what I have up, right? I mean, I'll adjust it and move it to expired, but that was the trade that we did, and there's a reason why we do that. I don't care if it goes over my strike. I care about what that short is, right? So the 75 short, I don't remember what I sold it for. I have to go look, okay? So let's just say, for example, that the whole trade cost me 135, right? That's August 75 is going to move up, right? So I'm going to win over there. And whatever I sold that July 31 expiration 75 for, okay, has to be, so let's call it, I don't know, let's call it $2. In order for me to lose on the short, the stock has to close over 77. Follow? No, I don't close. Why would I close the whole trade? I'll cover my short. Well, there's two expirations in the trade. There's the July 31 expiration, and then there's the August 21 expiration. I'm short the front month, and I'm long the back month. Because I thought my way of looking at that trade was, okay, volatility's high. The stock ran out like crazy. I want to get short the front month, but I'm not doing a naked short. So how do I do that? I cover the back side of it. So I go out a month, okay? I go out a month. I buy the August. The whole trade cost me $1.35. And if the stock, let's say the stock closes under 75, I get to keep the whole short. Follow? See, when you're going to do something like that, I would rather you do a calendar, because then, right, check this out. What is it? The 30 days is December, April, June, and November. So the 31st, right, is the expiration. So then you have what? August 7th, I think, is the next expiration. Yeah, August 7th is the next expiration, I think, or the 6th or whatever. Then I can just turn around after I close the 75 for July 31st. Then I can go short the next one. And you might end up making more money selling the shorts than you end up making on the back. You understand that? Can I unmute you while you want to talk? You want to talk on my webinar? Oh, unbelievable. And
All right. Can you hear me?
There you go. So everyone, welcome Alaska.
Thank you.
Because
Okay,
now he wants to talk.
Yeah, you can mute me again when I'm done with the question. I just want you to understand the question.
Go ahead, man. Go ahead.
All right. So let's say you're doing a calendar. Okay. So you buy the 75 strike and, expiring in July, you sell the August one. Or no, you buy the August, you sell the July. Okay. So what happens if at expiration, let's say July 24th expiration, it goes above, so the one that you sold, you now owe money on, right? So do you have to have the money in your account to cover that? And if you don't, do you have to sell the back month to cover that?
So you can do a couple of things. Okay. I'm going to mute you back so you can't talk. I'm just kidding. That's a good question. So what you can do is a couple of things. One is you can outright buy it back if you have the money in the account to cover what it's going to cost you. So like, let's say it was $3, right? If you only have $200 in your account in available cash, obviously you can't buy that. So you have an option. You either have to close the entire trade, right? Or you can then, in one simultaneous trade, buy to close that front week, and then go sell to open the same one the following week. Okay? Does that make sense? You're welcome. You're welcome. I'm so happy to help out. Look at that. See, this is what I will do. I will even let you interrupt me in the webinar and ask a question. I'm just kidding. I'm happy to do that. You guys know I'm happy to do that. So yeah, that was a good question. All right. Yes, I know we need the spreads class. I know that. I'm working on it. I've had a lot of real life stuff going on. I will get to it. Trust me. I want to get it done because I know you guys need the help. All right. All right. So I'm glad that answers your question. All right. So on the bottom here, it says all options trading strategies involve the use of spreads. And they represent a very useful way to manage risk, as I just did and showed you with Tony. Okay. You can use them to reduce upfront costs of entering a position and to minimize how much money you stand to lose, as with the bull call spread that I gave you in that example above. But like I said to you guys, it also means that you are potentially reducing the profits you'll make, but it reduces your risk, okay? And I'm going to go in and show you something. So hold on one second. I'm going to pause the screen, so bear with me, all right? Hold on. Escape. I'm going to go into somewhere. Let's see if I can get this to work. All right, so here we go. TSM. All right, so let's say, let me get the right expirations. All right, give me 1 second. I'm just working on something here. All right, can you all see my Thinkorswim? Can you all see my Thinkorswim page? Can you guys just type in there that you can see it? Okay, good. All right, so check this out. Here's what we're going to do. I'm going to give you this example like we were just talking about the trade that we actually did. All right, so let's go into it was the August 75 and the July. Let's go to calendar. So we bought the 21st and we sold that one. Okay, so here. So the trade is actually down 11 cents, which in the whole scheme of things is not a big deal. Okay, not a big deal. So you guys see how this works here. You would buy, see that? You would buy this one and the whole trade would cost you 124. All right, so let's go look at the trade. Let's go look at the trade. There's a 75 here. So we're going to go by the last. Whatever the last price was 230. Okay? So it's 230 and $1. Okay, so here it is so that you guys understand. If TSM on Friday is under $76, okay? So let's just say we bought the trade right now for this second. If TSM is under $76, right? Because the short, we would have gotten $1 credit, right? If it's under $76, we're going to make money on the short. Okay, so let's say it stays exactly where it is right now at $73.90. You're going to get that entire credit. It's going to expire worthless. And then you can either close it out on Friday for like 2 cents or 5 cents or whatever. Then you open up, boom, you open up August 7th. Look at that. Now you sell it. You know, it's not going to be $1.50 by then. It's probably going to be less. Okay. So let's say the price is still the same. It's going to be less. So let's call it another $1. You're going to sell this for another $1. Let's say it still doesn't close by August 7th over 75. You're going to collect that $1. So now you've collected $1 here and $1 here, and the trade costs you 124. We are now holding the long, and we've been paid to hold the long. Does everyone understand how that works? There's a bunch of you on here. I want to see all of you tell me that you understand how that works. If somebody doesn't understand how that works, I want you to type it in the room, please. Yes, it is. Because I think it's important, because we did the trade in the room. So if you're in a trade, I need you to understand how it works and what we're going to do. Because I said, plan to adjust the short next week. I am telling you what we're going to do. Now, let's say the trade really runs and it goes above 75, it goes to 76, or it goes to 77. That's great. If it goes to 77, fantastic. That means the backside, the August 21st expiration, is going to go up in value, right? That also means that that 75 front week is going to go up to $2, which means you're going to have to cover. But it also will mean, and all of you guys did not say that you understand, by the way, so please tell me that you understand. It also means that this August 7th that you're going to roll out of this and into this one on the short side is going to be worth more money, which means you're going to sell that too. But then you're still going to have 2 weeks between August 7th and August 21. Do you guys get that? Tony, I know you understand, but there's a bunch of other people in here and I want to make sure they understand. Because this is really important. Calendars are really, really important. Verticals are important. Calendars are important. If you understand verticals, you can do an iron butterfly. If you understand verticals, you can do an iron condor. Okay? If you can do calendars, you can do diagonals and double diagonals. And, you know, hold on a second. I'll show you guys. You can do, delete. Let's say I want to do this. You can do all these trades. See all these trades here? Unbalanced, double diagonal, collar with stock, vertical, iron condor, condor, butterfly, collar, covered stock, strangle, straddle, diagonal, calendar, back ratio, vertical, single. You can understand all these trades if you can understand the basics. Okay? Mr. Optimistic, the answer is no. The reason you would have to